JEPI's 60% return crushes JAAA's 25%, but that 14% crash and 8-month recovery reveal the real trade-off you're making. Now let's shift gears and look at JEPI's 60% gain crushed JAAA by 35 percentage points over 5 years. That's not just winning, that's total domination. But here's where it gets interesting. JAAA's 25% growth over 5 years is underwhelming. Growth investors won't even give this a second glance. In plain English, JEPI's engine delivered more than double JAAA's returns over 5 years. Same market conditions, completely different results. Think race cars on identical tracks with wildly different horsepower under the hood. JEPI's 34% 3-year return shows equity strategies consistently beating bonds. It's not just a one-year fluke. This approach delivers over time. Here's where the story takes a turn. JAAA's 22% over 3 years shows steady, reliable growth, but it's not competing with high-flying equity returns. Let's break this down further. JEPI's 9% yearly return keeps it ahead, even when you zoom into shorter time frames. In plain English, here's the marathon runner analogy in action. JEPI keeps pulling ahead at every checkpoint, building its lead consistently. JAAA stays in the race but never quite catches up to the frontrunner. Now for the real question. JAAA's 5% annual return is solid and steady, but if you're chasing aggressive growth, you'll need to look elsewhere. Let's dig into the details. JEPI's Sharpe ratio sits at 0.6, decent returns for the risk taken, but something's about to shift this perspective completely. Here's where things get revealing. JAAA's Sharpe ratio of 0.5 means it's delivering decent returns without taking wild risks, steady and predictable for conservative investors. In plain English, JEPI's like cranking the amplifier knob. You get louder music but also more distortion. JAAA keeps everything smooth and predictable. Higher returns usually mean bumpier rides. But wait, there's more to this story. JEPI's Sortino ratio of 0.8 focuses on downside risk, showing how well it protects you when markets actually fall. Here's the thing, though. JAAA's 1.8 Sortino ratio crushes it, more than double JEPI's efficiency when you're measuring what really matters: downside protection. Let's take a closer look. JEPI's 8% yield is impressive. That's the kind of steady income most investors hunt for but rarely find. In plain English, think of dividend yield like a pizza. JEPI serves you a bigger slice right now, while JAAA's slice is smaller today but has better ingredients for future growth. But that's not the whole picture. JAAA's 5% yield is solid for bonds, but it's only half what JEPI delivers, meaningful if you're chasing income. Let's see how this plays out. Here's the problem. JEPI's payouts actually fell slightly over 3 years. Negative 0.8% growth kills the income story. Here's what really matters. JAAA's dividend jumped 54% over 3 years as rising rates pushed bond yields higher. That's solid income growth for investors. In plain English, think of it like leaves growing. JEPI's income tree is mature and stable, producing consistent dividends. Meanwhile, JAAA's tree just had a major growth spurt in its payouts. But hold on a second. JEPI's worst drawdown was only 14%. That's the kind of mild turbulence most income investors can actually stomach. Let's unpack this a bit. JAAA's worst drop was just 2.6% over 5 years. You could practically ignore market meltdowns and still sleep soundly at night. Here's the key takeaway. All right, pause time. JEPI or JAAA. Who's your winner? Drop your vote now. In plain English, here's the difference in drawdown risk. JEPI can sink hard during market storms, losing significant value. JAAA barely moves, ultra-stable, almost boring. It's stormy ocean versus calm lake. But there's a catch. Nearly 9 months waiting just to break even. That's the patience you'll need when JEPI takes a real hit. Let's get into the weeds here. JAAA's shallow dip meant a quick recovery, just 146 days to bounce back. Less damage equals faster healing for your portfolio. Now, let's shift gears and look at JEPI's 11% volatility means you're looking at relatively calm price swings, way less chaos than most growth funds deliver. In plain English, here's your perfect tightrope walking analogy. JEPI wobbles significantly crossing that high wire, while JAAA strolls along ground level, barely budging. That's volatility in action, folks. Let's zoom in on this. JAAA's 1.7% volatility over 5 years means your investment barely moves. That's bond-like stability with zero drama or sleepless nights here. But here's where it gets interesting. JEPI's volatility sits at just under 5%. Pretty steady swings even when markets calm down. Here's where the story takes a turn. JAAA's ultra-low volatility at 0.64% means your principal barely budges. It's the stability you want when preserving capital matters most. In plain English, JAAA's like a metronome, steady, predictable ticks you can count on. JEPI? That's more like a clock with a caffeine problem, speeding up and slowing down unpredictably. JEPI's 0.35% fee seems reasonable now, but over decades those costs compound and chip away at your returns significantly. Now for the real question. JAAA's 0.2% expense ratio beats competitors by 0.15% annually. That difference compounds into serious savings. Over the years, you'll hold it. Let's dig into the details. Here's the classic trade-off. JEPI delivers higher returns at 60% over 5 years, but you'll stomach a 14% crash. JAAA's safer at just 25% growth with minimal downside. In plain English, couch change adds up faster than you'd think. A seemingly harmless 1% fee might sound like nothing today, but compound that over 30 years, and you're looking at serious money lost. Now let's put this in perspective. With a 0.9 correlation to the S&P 500, JEPI essentially mirrors the market. No diversification happening here, folks. But wait, there's more to this story. JAAA's 0.2 correlation means when stocks crash, this bond fund barely flinches. It's running on completely different rails here. Here's the thing, though. JAAA's low correlation with stocks means real diversification when you need it. JEPI just follows equities with minimal portfolio protection. In plain English, think of it like dance partners. When the stock market zigs, JEPI zigs too. But JAAA? It's doing its own thing, completely independent. That's diversification in action. Now here's where it gets tricky. With 110 different stocks in the mix, JEPI's diversified enough that no single company can tank your entire portfolio. But that's not the whole picture. JAAA spreads your risk across 483 different bonds. If one issuer fails, you've got 482 others backing you up. Let's see how this plays out. JEPI's pulled in a massive $42.7 billion. That's serious investor confidence betting on this income-focused strategy. In plain English, fund size is basically couch change adding up. When billions of dollars pile in, it means millions of investors trust the strategy enough to drop their coins in. Now let's connect the dots. JAAA's pulled in $25 billion in assets. Smaller than JEPI, sure, but that's still huge for a bond fund. But hold on a second. Watching your portfolio drop 14% isn't just financial pain. It's emotional torture that pushes investors to make terrible decisions at the worst possible moment. Let's unpack this a bit. With a maximum drop of just 2.6%, JAAA lets you ignore market panic and actually sleep well at night. In plain English, here's the psychological difference that matters. JEPI's volatility will have you obsessively watching prices. JAAA's stability? You'll sleep well and actually forget it's there. Now let's flip the script. If you're living off your portfolio today, JEPI's 8% yield covers bills that JAAA's 5% simply can't handle. But there's a catch. JEPI's 60% 5-year gain shows you're getting real equity growth, something bonds just can't deliver no matter what. Let's get into the weeds here. JAAA's tiny 2.6% maximum drawdown means your principal stays protected, critical stability when you can't afford losses in retirement. In plain English, here's your egg basket reality check. If you'll panic seeing your account drop tomorrow, JAAA's your safe bet. But if you're patient enough to ride out the storms for bigger rewards, JEPI's worth considering. But here's where it gets interesting. A 258-day recovery sounds manageable until you realize that's 9 months without access to your money when you need it most. Let's zoom in on this. JAAA bounces back in just 146 days, 5 months from bottom to break even. That's fast enough to keep your sanity intact. Here's where the story takes a turn. JEPI's dividends are actually shrinking at negative 0.8%. Your income stream could dry up right when you're counting on it most. In plain English, JEPI's sprinting ahead right now with strong returns, but that pace might not last. Meanwhile, JAAA's picking up speed after a slower start. Think of it like different runners approaching the finish line. Let's break this down further. JAAA's impressive 54% dividend growth was driven by rising rates, but don't expect that to repeat if rates stabilize. Here's your investment choice. JEPI gives you equity growth with income, while JAAA brings stability to balance things out. Now for the real question. Here's your portfolio balance. JEPI delivers growth and income, while JAAA anchors you with stability away from stock market chaos. In plain English, think of JEPI as your skyscraper reaching for growth, while JAAA is the concrete foundation keeping everything from crumbling. One builds up, the other keeps you grounded. Here's where things get revealing. Youth gives you the ultimate advantage here. You've got time to weather JEPI's swings and bounce back from any losses. Now, let's put this in perspective. When you're living off withdrawals, a 14% drop doesn't just hurt, it can derail your entire retirement plan permanently. But wait, there's more to this story. Here's what really matters. Some folks handle 11% swings without blinking, while others panic sell at the worst possible moment. In plain English, personal risk tolerance is your emotional roller coaster limit. Some investors thrive on wild market swings and big drops. Others need the calm, predictable ride that lets them sleep at night. Let's take a closer look. Both JEPI and JAAA get taxed at ordinary income rates, meaning you'll hand over more to the IRS than with qualified dividends. Now here's where it gets tricky. Neither fund helps you here. Both JEPI and JAAA generate regular taxable income, so shelter them in retirement accounts. But that's not the whole picture. JEPI wins on total returns, but JAAA takes the crown for stability and risk control. Your goals decide the winner here. Let's see how this plays out. JEPI's built for moderate investors chasing income and growth over 5 to 10 years, while JAAA targets conservative short-term capital preservation. In plain English, here's how these funds stack up. JEPI's report card shows strong marks in growth and income, but stability's a weaker subject. JAAA, safety's an A+, but returns barely scrape by. Now let's connect the dots. This isn't financial advice, just education. Do your own research before investing. But hold on a second. Want more battles like this? Hit subscribe for weekly deep dives breaking down ETFs with data you can actually use.